401k savers today are faced with an important question. Should I save using traditional pre-tax dollars, or am I better off with the Roth after-tax option? As is so often the case when it comes to financial planning questions, the answer depends on the unique aspects of your personal financial situation. So while we may not be able to provide specific guidance to you, we can use an example to help you better understand the difference between pre-tax and Roth so that you can make a more informed decision. For starters, keep in mind that there are tax advantages to both pre-tax and Roth after-tax strategies. In the case of traditional pre-tax savings, the tax benefit is realized during your working years, while the Roth 401k account will provide tax relief during the distribution phase of your life. Not all 401k plans offer the Roth feature, so check with your Human Resources Department to verify whether this strategy is available to you. Before we get to our example, just a reminder that everything we present in this video is intended for educational purposes only and should not be construed as advice. For this illustration, we'll assume our worker Max is 35 years old and has a gross annual income of $60,000 paid twice per month, and she plans to retire at age 65. Max is saving 10% of her pay, and to keep the math simple, we're going to make a few totally unrealistic assumptions. We will not factor in FICA taxes, and we'll assume that she never receives an increase in pay throughout her career. Finally, we will not include any state income taxes in our projections. Keep in mind that our goal is to simply explain the difference between pre-tax and Roth saving strategies, so we're going to eliminate as many distractions as we can along the way. Our analysis will use federal income tax rates in effect as of September 2021, and we will use an average investment return of 8% in the 401k account. Let's start by examining the impact of two saving strategies on Max's paycheck. Her $60,000 annual salary will result in semi-monthly gross paychecks of $2,500. In the traditional pre-tax scenario, her 10% contribution will be deducted from her paycheck before income taxes are withheld. Max is left with $2,250 of her paycheck subject to income taxes. Once Uncle Sam collects his portion, Max's employer will deposit $1,780 into her account. Now let's see how things change if Max makes a Roth after-tax contribution. In this scenario, her entire paycheck will be subject to income tax, which means she'll have to pay $525 in federal income tax pay each period. Max's 10% Roth 401k deferral still applies to her gross pay, so the same $250 contribution will go into her 401k account. After her Roth contribution and her income taxes are taken into consideration, her net pay ends up at $1,725. It's important to remember that whether she's contributing using the pre-tax or the Roth after-tax strategy, the same amount will be deposited into Max's retirement account. The difference between the two strategies in the short term is the net effect on her take-home pay. By paying the income tax now, Max walks home with $55 less each pay period in the Roth scenario than she would if she were saving pre-tax. Now let's take a look at the long-term impact of these strategies on Max's take-home pay over the span of her career. A $60,000 annual salary multiplied over a 30-year period of time results in $1,800,000 in total gross pay. Since Roth contributions are made after taxes are withheld, that entire $1.8 million will be subject to income tax, which means Max will have paid just shy of $200,000 in federal income tax during this time period. If she goes the traditional route instead, those pre-tax annual contributions of $6,000 reduce her cumulative tax income by $180,000 over the span of her working years, resulting in a total federal income tax liability of just over $156,000. While the total dollars saved in either scenario are the same, the impact that Roth after-tax contributions have on Max's take-home pay means she'll have about $40,000 less to spend throughout her working career. Now that we understand how these two strategies will impact Max's income tax and net pay throughout her career, let's take a look at what happens once she retires. Using our assumption of an average 8% investment growth rate during her working years, Max is projected to exceed $740,000 in retirement savings regardless of whether she used the pre-tax or the Roth after-tax strategy, since both accounts grow tax deferred. But what happens when Max starts collecting income from her account? 100% of the money distributed from Max's traditional pre-tax 401k will be subject to income taxes. If she were to have made Roth after-tax contributions, while she did have to pay income taxes on the $180,000 that she contributed throughout her career, all $740,000 in a retirement account, both the principal and the earnings, would be distributed tax-free in retirement. While we cannot predict what federal income tax rates or brackets will be 30 years from now, our illustration assumes that by contributing to her 401k on a pre-tax basis, she would have reduced her taxable income by $180,000 during her working years. While Max's Roth 401k contributions would have resulted in nearly $41,000 in additional income tax payments throughout her career, her entire Roth balance will come out tax-free at retirement. Changing any of the factors in our scenario, from Max's income and contribution rate to her time horizon or the rate of investment return, will have an impact on both the short and the long term. We obviously cannot illustrate every possible scenario in this short video, so we encourage you to carefully consider your timeline as well as your unique income, financial, and tax situation before determining which strategy is likely to provide you with the outcome you prefer. If nothing else, keep in mind that both savings vehicles offer powerful tax advantages. The biggest difference between the two is when you will receive the tax benefit. The pre-tax strategy reduces your taxable income during your working years, while Roth provides for tax-free distributions throughout retirement. As always, we recommend that you work with a trusted advisor to determine the best course of action for your personal situation. For more educational content like this, please subscribe to the Annex Wealth Management YouTube channel.